we're gonna start sharing our screen. So, wow, it's amazing. Just as a preface, it's amazing how quickly 10 weeks can go by, and we're full swing into the second quarter. And as you all know, a lot of volatility here going on. Definitely based on the pulse that I have, definitely some nervousness out there, and I understand that. But you know, these things will pass, and we'll kind of get to smoother waters at some point in time. And so if you all have questions on the current capital markets, feel free to reach out. If you're going to schedule a one-on-one anyway, we can kind of talk about those kind of things. But today we're going to kind of wrap up this Pre-Retiree Academy and the foundation for retirement, and kind of, you know, maybe what next steps that I can suggest to you guys as well. So I'm going to go on and share my screen. And pull something else up. Okay. So just a couple quick things that I prepared that you all can kind of have these dates or ages that was suggested that we kind of have in one way or another, is just having some deadlines, key deadlines in terms of things that can impact your retirement. So, you know, obviously if you're on the younger end of planning for this, and you're younger to mid 50s perhaps, you know, once you turn 50, you're eligible for the catch-up contribution. That's an additional $6,500 on top of the current limit, for a grand total of $27,000 that you can put away. If you're behind, it's totally designed for you all to literally play catch up, and it allows you to put more dollars and defer more dollars from your own salary. So at the age of 50, you attain that. 59 and a half is when the penalty for early withdrawal drops off, whether it be an IRA or a 401k or 403b, no matter what you're in. I would say this though, if you're going to leave it in the plan and you're still working, plans have different what's known as in-service distribution rules. So you would need to make sure for your particular plan, if you were thinking about doing that while you're still working. Most people aren't, but it is an option that's out there. 62, that's your earliest option to elect Social Security. I think most people understand that. Before you kind of make that decision, and we're going to talk a little bit more about this today, I would really suggest going online, finding one of the Social Security calculators out there before you make that decision. It's definitely can be detrimental if you don't kind of plan that right, because once you elect it, that's kind of it. That's the amount you're going to get, plus maybe some cost of living adjustments. Age 65. This is whether you are going to actually enroll. You have to sign up your paperwork when you turn 65 for Medicare, whether you take it or not. Please do that. If you don't, it can subject yourself to a 10% penalty, and that's kind of ongoing in perpetuity going forward. So it's important, even if you're not going to use that quite yet, to sign up for it. We'll talk more about that in the Medicare section of the wrap up as well. 66, 67, that's kind of where we're at in today's terms and for full retirement age as it relates to Social Security. Social Security maxes out at 70. So if you're going to wait that long, make sure you take it. It's not going to go up anymore after that. And then 72, you know, we put in a little disclaimer or a little text box there. Access what you saved. If you hadn't started taking from your 401ks or IRAs at that point in time, then that is the age of the required minimum distribution. So if you hadn't started taking out, or you're not taking out enough, there is a factor in which you will have to figure out each year based on the December 31st balance of your account, and you multiply that times by the IRS factor for your given age, and that would tell you your required minimum distribution. However, that could increase in the near future, maybe. There is a bill that has already passed the House, and it is an upgraded version of the Setting Every Community Up for Retirement Enhancement Act, otherwise known as the Secure Act. And the one that passed the House is known as Secure Act 2.0, which has got some additional changes to it. In there, they have put in to possibly increase the required minimum distribution age to 73, with an escalation clause, meaning in like 4 or 5 years it would go to 74, and another 4 or 5 years to 75, and that would be it. Of course, you know, anything can change when it goes to the Senate if it gets passed at all, but just to kind of give you an idea where things stand with that. So we're going to go through and review pretty much everything that we've given out, not in full, so not everything that was sent, but just as a, you know, a foundational reminder of kind of where you need to be. And so, you know, you've heard me say it, but all of, you know, it's so important to start with a budget. And if you don't know what you're going to budget for in retirement, you're not sure on that quite yet, then start with what your current budget is. And that will help create a potential retirement spending plan. It will also, you know, give you an idea if you're trying to pay off a mortgage before you get to retirement. You know, your current budget is this, but in retirement, you know, certain expenses may go away based on your current budget. That's why that can help you do that. Very important, I would plan for unexpected expenses. Even if we upgrade and get a newer house, things tend to go, you know, bad in houses, whether it be a water heater, and I don't even know what the average life of a water heater is, not going to pretend to, but my guess 10 to 15 years, you're going to need that. You know, HVAC is a quite extensive thing. So, you know, what I would do is average in some of those things, you know, for upkeep and unexpected stuff from time to time, and just throw it in there as miscellaneous unexpected. I think that's really important to kind of budget for that. You'll have years where you won't need that kind of stuff, but at least you're carrying that over. And then when one of those larger expenses happens, it's been accounted for, at least in aggregate, if that makes sense. You know, creating a retirement budget and principles like creating that budget for here and now. There's 3 main components that make up a retirement budget. Your monthly expenses, and if you don't know that, use them as a version from your current. You know, be sure to go through your fixed expenses, your variable expenses, and then add in your needs versus wants. Your retirement expectations. So if you're going to change the way you live, where you live in retirement, if you're not there, don't just plan for that to happen. Do some research on how much more it might cost you to live somewhere else, or maybe less in some expense. But you know, the closer you get to drill down on these numbers, the better. And then of course, what your expected monthly income is, and we'll talk about those components of your income, you know, shortly. You know, in week 3, you were provided with a personal financial statement template, also known as a net worth statement. And you know, once you kind of have that budgeting piece, I think it's worth tracking your assets and liabilities. It can help you plan for those retiring debts prior to retirement. I also think that there's a beneficial mindset shift that comes with tracking that, whether you pay off your debts and you kind of get that real feedback in the immediate time as you're doing that and updating it. You kind of get that self-gratification that, you know, your net worth is rising either from saving more or spending down your, paying down your debts. And so I think that's a satisfying process. It reaffirms a kind of your commitment and action plan that you've taken. And honestly, keeping a net worth statement, this is kind of what it looks like and then it had those cells you could drop down in there. But I think keeping a net worth statement is very handy. Also, just to keep a copy of it in or near your estate plan, just to let your heirs know kind of where stuff is if you haven't told everybody or anybody. People are very different about that. Some people don't want family members and others to know what they have and are going to leave behind, and others do, and that's a personal choice. But I think in any case, if so people don't have to look for those kind of things or guess, if you at least keep a net worth statement with some of your estate planning documents, it can serve as a good kind of, listen, this is what I had as of this point in time, as a snapshot. I think that's very helpful, honestly, if you're trying to keep some of that stuff close to vest, which is understandable. So we're talking about, you got to identify as part of that budget where your money's going to come from when you retire. Social Security, we're going to talk about, some of those, some of the tools and some of the strategies you can use for that Social Security. But that's going to be a portion of everybody on the call, in my opinions. Income replacement, pensions and or retirement plans. You might have income from assets. Some of you all know have rental property. You might have income from earnings. You might not fully retire. Maybe you're going to retire from this and then do a part-time job, or maybe you have other forms of income that we've not covered. But it's important to kind of understand that all of those pieces are what's going to kind of go towards your replacement income. If you want to do it the kind of a general rule way, and you're not going to actually get that spending plan down to the to the dollars or near it, then the easier way is to look at that 80% income replacement. That should be a goal for everybody on the call, higher than 80%, and that's what your pre-retirement income is. So take all your savings and your Social Security, net out the money you're going to need from that 80%, and then from there, you can put it in some calculators and make sure that your money's going to last you well into your expected lifetime. About 30 to Social Security is not enough for anybody to cover it. We've talked about that. I'm not going to harp on that. It's really only designed to be a safety net, covering anywhere from 30 to 50% of previous income and those kind of things. But as an average income replacement need, 80% is the number that you all should strive to be above. So Social Security strategies, let's talk really quickly about maximizing Social Security for you and your spouse by claiming it later. And so this is the maximizing lifetime benefits. It's not rocket science. The basic principle is the longer that you defer your benefits, the larger those monthly benefits are going to grow to, and the more beneficial that is over your lifetime. Each year that you delay Social Security from age 62 to 70 generally increases that amount by 8% per year. So if you were thinking about going at say 65, then you would want to do it, and your full retirement age is 66 and a half, then you would want to subtract 8% from whatever that number is on your statement, and then go from there. The maximization of lifetime benefits is a strategy that works best for couples that have normal to high life expectancies and couples that have had similar earnings, who plan on working really to that full retirement age, and have sufficient savings to kind of overcome and delay doing that. With shorter life expectations, people might consider claiming early because that's a way that they're going to be able to maximize benefits that they played into. So, obviously you can go as early as 62, as we said before. And if you are going to have a shorter retirement period, or you have massive health issues, generally one member of a couple would want to live into their 80s for that increased benefits to offset the sacrifice of the other person going to 62. So it's not a one or the other. This is a deal where one person will go on and take it earlier in an event of couples, and the other person will strive to delay that. And we'll talk about reasons of why that is. But so delaying the lifetime survivor benefits. So when you pass away, your spouse is eligible to receive your monthly Social Security as a 100% as a survivor benefit. But they only do that if your spouse is the spouse that died's benefit was larger than the one you have or going to take or have taken. So if it's not larger, you would keep the benefit you would have going. If you start taking Social Security before your full retirement age, you're permanently limiting that partner's survivor benefits. And a lot of people, I think, overlook that. So many people overlook when they start say collecting Social Security at 62. Whatever that number is what your spouse or partner, that number amount at 62 will be what they can claim as 100% benefit for themselves. So who needs to think about that? If you're close in age, then honestly, you all can stagger them. If the spousal if your spouse is quite a bit younger and your benefit is going to be higher, then you should seriously explore delaying taking that at least to full retirement age and sometimes later. And the reason is because if that benefit is going to be bigger, it'll be bigger kind of forever. So let's consider the example that's on the page. A hypothetical couple who are both about to turn age 62 in this case. Aaron, he's the gentleman on the left, is eligible to receive $2,000 a month from Social Security at his full retirement age, which is 66 and 6 months. He believes he has average longevity, meaning he thinks he'll be about life expectancy that's around 82 these days. His wife Elaine will get $1,000 at her full retirement age of 66 and 6 months based on her health and family history, but anticipates living an above average life expectancy until their 90s. So originally they were planning on to claim at 62, and that's when he would have gotten $1,450 a month and she would have gotten $725. That's because they're claiming earlier. It's about a 27.5% lower benefit than it would have been at full retirement age. If Aaron waits until he's 66 and 6 months to collect, he'll get $2,000 as opposed to $1,450. And if he delays it till 70, that's another increase of 28%. That's almost $2,560 a month. And not everybody can do that. And I generally, it takes a special situation of knowing, health and longevity pretty substantially. But those calculators online can really help you. So, I mean, waiting till, at least full retirement age, if not 70, if he waits to 70, that's going to be her lifetime Social Security increase. It's almost $70,000 or 16% on that. So as you can see from here to here. So very important to kind of look at those. You don't have to know exactly what that is right now, but just be thoughtful of that. I know a lot of people just say, well, when I retire, I'm going to go on and take it. So I find often when we do financial plans that it's beneficial to go on and wait a couple of years and just draw it from your retirement savings, because the 8% return on your money is pretty significant. The 8% increase in benefits, what I mean when I say return on your money. And it's not just the 8%, because if you continue to work, it could be more than that, but if you retire, it is 8% every year that you wait. When to take it again, this goes back, it's different for everybody, but it kind of shows you the reduced benefit ages and the difference. This is just an average salary of $45,000 and what a payout would be. I mean, you can tell $1,200 versus $1,600 or $1,700. I mean, that's pretty substantial and as you get up towards 70, it's very big. But I often don't recommend people wait till 70, quite frankly. But I mean, if you have good health and good longevity, then it's something to seriously think about. So you've heard me say before, there's always 3 questions that have to be asked when we retire and determine a withdrawal strategy. It's, when do you need the money? When are you going to start pulling money from those accounts? How much is that withdrawal that you're going to be making from that? What is your need, in other words? And for how long? And the last one, of course, we do not know. Yeah, that is the one that's very difficult. So in connection with that, there's quite a few factors that you can't control that can have an impact on your withdrawal strategy. Longevity. If we live longer and we haven't quite saved enough, we run the risk of running out of money. We can't control some of those things. We can control the saving side. So being disciplined on how much you're taking out is very important. Your returns, your strategy's got to be flexible enough to account for market fluctuations. We're seeing that right now. It's ugly, and there's nowhere to turn that I can tell you that it doesn't look ugly at the moment. We're just in that unique situation, but over time, 5 years from now, 7 years from now, certainly, certainly over time, the averages of what that volatility looks like changes greatly. And as you go farther and farther out, it becomes more predictable in terms of what those returns will be. So the short term is rough, but the longer term and medium terms tend to be a little bit more smooth. But we can't, all we can do is prepare the risk. We'll talk about that. Inflation, boy, we're feeling that right now. It's kind of part of the perfect storm that we're in, of rising interest rates and the Fed's unwinding their balance sheet by selling the government treasuries and bonds that are out there. It's having a significant effect on the marketplace at the moment. And but inflation is a big proponent of that. It will come down over time, but obviously everybody wants it to come down sooner than later. But inflation is for investment and retirement accounts. If you're too conservative, it's kind of like death by paper cuts. It stings a little, but it takes a whole lot of it over time to kind of really erode that, and it changes your buying power pretty significantly if you're not careful. Future expenses. Again, we talked about that. Just, account for unknown expenses and unexpected expenses, very important. So on to withdrawal strategies. Let's start with the basics of what we talked for in that one of the early, webinars that we did. How do I access our money? Let's take that first. So if your money is an employer sponsored plan, like a 401k or 403b, you're going to have to contact your custodian for the specific options available to you within the plan. Some of those will carry fees, and I can't give you a general because it's different for every custodian, record keeper, and plan. And in my experience, they do charge the withdrawal and distribution fees. They are higher. And so for that reason, a lot of people do shift to the IRAs, typically have no fees for withdrawals. You can set up a monthly electronic withdrawal and do the a la carte as needed as well. You can withhold taxes, but you can do the withhold taxes in the 401k or 403bs. Most record keepers will have you withhold 20%. And then, even if you're not in that bracket, you'll just get a refund at the end of the year. And then they will help you determine your RMDs on that as well. And IRAs, it's either up to you, or if you have an advisor, that's what you hired them for, obviously, as well. One of the positive sides, I would say, I think that will change over time with the 403b and 401k accounts. I think fee compression is going to continue. And what I mean by that, fees have been coming down on these accounts for quite a long time, and I think they're going to continue. And it wouldn't surprise me if some of the fees in terms of like for withdrawing your money and those kind of things, figuring RMDs and those, it wouldn't surprise me if those start to drop in the future as well. I don't have any basis other than perspective. I think that that's going to continue, and I think it will affect some of those. There's no right or wrong between these two. I think IRAs give you a little bit more flexibility in terms of you get the whole universe of investments selection. I think some advantages over like a 401k from a fixed income side is the 401ks have the stable value funds. Those are very appealing, particularly at the moment for, to use as portions of fixed income. But at the same time, they also have bond funds, and the bond funds are harder to control duration because there are so many of them and they're constantly turning them over. I find it easier to be able to either buy individual bonds or what are known as I bonds and control the duration of those, so you're not getting squeezed by the increases like we are now. I think those kind of things, not a recommendation of one versus the other. I just think you can be a little bit more creative in the IRA because you don't have restrictive, you're not restricted to just whatever's in the plan. However, I mean, the fees for what you all have and all of your plans for the types of investments you're in are very attractive as well. So the withdrawal strategies, just quick review. There's the 4% rule: withdraw 4% of your retirement savings in your first year of retirement, and then subsequent years you tack on an additional 2% to that amount. And so you're just trying to keep it near 4% plus the 2% to adjust for inflation from time to time. Generally, if you're able to say a 4% or under, you'll read things that say that you'll never, you will not generally run out of money. I kind of tend to think that's true. Fixed percentage or fixed dollar withdrawal is very self-explanatory. Fixed percentage withdrawal, this approach is really close to the 4%, but you're just setting a percentage of your portfolio annually. The dollar amount of the distribution will vary based on how much you have in your portfolio. So if you do 6%, it's 6% one year might be more because your portfolio is up, and if your portfolio drops, 6% might be less than that. Systematic withdrawals, in this you plan to withdraw only income from your investments, such as dividends, interest, or gains perhaps created from the underlying investments in the portfolio. Bucket strategy, this is one I probably use more often than not. With the bucket strategy, withdraw assets from 3 different buckets, and you have 3 different types of holdings, and a fixed income or cash bucket, a equity or growth bucket, and diversifying strategies is kind of how we build ours. And on top of that, we make sure that we have the correct amount of years in terms of income needs in that fixed income bucket met, and that will help determine your risk in some ways. Evaluate your risk. So, whether you're being prudent by completing some advanced planning, or you're concerned that recent market volatility is a prelude to a sharp or broader downturn, and it's possible it could be, I suppose, you're right to start thinking about transitioning your portfolio to a more conservative stance, well before you retire. Investing heavily in stocks is, often acceptable for young investors and for people who are growth oriented with time on their side. But keeping high concentration of equities and stocks while being in retirement can have really bad consequences for you in the event that you're pulling money from those assets while they have drops. And so being too aggressive can be a really tough issue. So I'm going to show you this. Beware of sequence of returns risk. So if I can get this to come up. Hold on one second. Let me bring this over. So I've built that in so when you all download it, you can click on it. So sequence of returns risk is a, oh, sorry, is a, well, hold on. There we go. Sequence of returns risk is a real, it is a real issue, or can be a real issue for people. And what you're looking at is when you're savings, it really doesn't matter what the sequence of returns are. So this is year one when you start, year 2, 3, 4, and you can see the returns. Everybody's putting in the same amount. You know, they're getting the same average increase, which is 7. And no matter how you kind of get there, it doesn't really matter when you're saving. So if in your first year, it doesn't matter if the market's up 22% and it's down a couple of years in the middle, or if you start off and it's down, or if it's even across the board. The variances in the ups and downs of the market don't matter when we are saving, but they matter a whole lot more when we're withdrawing. The story changes as soon as you begin retirement. Portfolio withdrawals compound losses, meaning they add to your losses because you're pulling money out when your portfolio is down, making it harder and taking longer to recover from portfolio decline, especially to losses early in the sequence, meaning that if you have big losses early in your retirement period, it can have bad consequences. And so you can see this is 3 different ways in terms of doing it. The person on portfolio A, you know, year 1, 22%, year 2 up 15, year 3 up 12, then down 4, down 7, and up 7. And then this one is 7 across the board. But look at the difference in how the portfolio ends up, because this is someone taking $60,000 out of their account a year. In this case, it stays pretty steady on that top one, right? But look what happens on the bottom one. They're pulling 60,000 out when it's down 7% and 4%, and their money doesn't last them till they're 70. It can be a big deal, guys. And so taking too much risk in retirement can have issues. So just be aware of that. Be aware of that, and we'll move on to that. Let me bring this back up. Sorry, I closed it out inadvertently. We'll go back to where we were. Oops, sorry, too far. So just make sure that you evaluate your risk. If we do a one-on-one, we'll talk about it. That is not a simple conversation, especially right now. But I can tell you methodologies of which I look to use in order to make sure we're not taking too much. So, you know, whatever your mix of stocks and bonds you elect, you definitely want to think about that next overall allocation, what it should be actually when you retire. So questions that can help you get there is, how long is your savings projected to last, given the size of the withdrawals you plan on taking? If we do a one-on-one, I'm going to plug that in a really quick calculator no matter what, and we're going to see that. That's one of the things I like to do for my comfortability. How comfortable you seeing your retirement savings value fluctuate with market volatility? I don't know a whole lot of people that enjoy any fluctuations, let alone in retirement, but it is going to happen. It's how we approach those withdrawals when it happens is important. What other sources of income do you have? Social Security, pensions, taxable, home equity. I would add to that, it's really, you know, if you're not going to be taking from your retirement and you're just going to be living off some of these other things, then your risk can stay a little higher in most places, because it always comes back down to when you're going to start pulling money from that. I would also say, as a practical matter, many people enter retirement somewhere between 40 and 60% of their savings in stocks. Often I see it closer to 40, between 40 and 50, 55. But I do have a couple of clients that are still 60% in stocks or so. Okay, on to the next. And hopefully all of you all got to see the webinar with Lyle. I got a lot of really good feedback from that. And I really appreciate Lyle doing that. It's just really important. And I can tell you, we've been working on my dad's estate for many years, on and off, changing things back and forth as his life and wishes changed. And I lost my dad a little over a week ago. And I can't tell you how grateful that I am that we did this up front. And not only did we do it up front, we got all of the assets titled in the manner in which we should. And the transition to my mother is going to be so much easier. And in fact, it's mostly already done. The only reason it's not is because she just got back from Florida yesterday. So, you know, the reason we have this estate planning is to have a say in what happens to yourself, your loved ones, and your assets when you cannot. When you can't say it, this is what these documents do. It sets up structure, it minimizes conflicts between family members, and most of all, it spells out the wishes of what you want done with your money. And I think that's important. Added bonus is that it helps take inventory of what you have in those. You know, just as a review, if you don't have an estate plan, the probate court judge and the laws of the state get a huge say, especially when it comes to guardians of children and those kind of things. You may have or don't, you may have people who become in charge that you don't want. So it's very important. The laws of each state are different, are going to dictate that. But it will help keep things efficient, and it can protect much more than just assets. It can protect a lot of heartache and time from the next person to having to deal with that in a lot of cases. Just as on your screen, just things that the estate plan will include: a durable general power of attorney, healthcare power of attorney, a will, a living will in cases spells out, you know, if you get to a certain point, you know, that you know, it's incessantly, you know, you do not want to be resuscitated if you're deemed, you know, incapacitated, or not just incapacitated, but terminal, or those kind of things. You can spell all those things out on your own. You can do healthcare directives, organ donations, revocable trust. Super simple, can help a lot of people transfer one asset to another without having to go to probate court. And the retitling of those assets, it's not good enough just to have a trust. It doesn't do you any good if you don't title or put any things into it. So it does take some legwork, maybe to quick deed your house. If that's what you want to put a house into a trust, you can rename checking accounts, investment accounts, those kind of things. Beneficiary designations and guardianship designations. Make sure you get those kind of things. And then there is life insurance trust as well as irrevocable trust, which just means they can't be changed. But those are just examples of stuff that need to be, and about half of this is kind of must see TV, as they say. It's kind of must haves. Beneficiary designations. If you don't have your other stuff, check your beneficiaries annually, not just on your 401ks and those kind of things. A lot of y'all get insurance through your work, life insurance benefits. Check your beneficiaries through that. If you have your own life insurance policies, check your beneficiaries. It doesn't take much time. Beneficiaries supersede wills in Kentucky, but in almost every state in the union, from what I understand. Properly designating beneficiaries for life insurance or your retirement assets is part of that. It's an important part of the estate planning process, and keep them updated, because if you don't change them and something happens to you, someone who you might not want to get that money, or maybe someone who is not alive, and then it will go into probate, and then if you don't have a will, then the judge will decide who gets it. Just keep them updated. It's a lot simpler. Children can be beneficiaries. They're generally entitled to receive distributions directly once they turn 18. Otherwise, it would have to go through some sort of guardian, but it would still be deemed their money. Trusts work really well for a beneficiary of life insurance, but it's very uncommon to see trust as beneficiary. It's not necessary, but I do see it from time to time on retirement assets. Life insurance. So, this was a handout that came out, and I try to make life insurance as simple as possible. Life insurance at its core serves two purposes. It either creates an estate, meaning helps pay for debts, creates money in order to pay off something or create maybe almost an endowment to replace your income. It creates an estate, or it is useful to help pay for one if you are above the estate tax exemptions. That is quite high right now, $11 million a person. I suspect that will come down in the future. I don't know that they wanted to do that into last year, and it just didn't succeed. But I would expect that to come down. Check the beneficiaries on that. There's a couple of different policies that you can have. There's more than one, but there's term policies and permanent policies. Permanent could be whole life, universal life. It can be indexed, variable, and it can be, there's lots of different kinds on that. So what I would say is, if you have an existing policy, is it term or permanent, what's the purpose of it? If you have no debt and you're going to have money to leave to the next generation, then if you have a term policy, then that's probably a trigger that you probably don't need to keep it if you already have the liquidity and your debt is there's no debt you're carrying with you or could carry past your death. If it's a permanent policy, I generally make a recommendation to look into your premiums on that based on the cash value that you've accumulated. And we'll talk about that in just a second, because I've got some questions that you guys have asked me, and I had one of those on here. Life insurance is good to help protect income during retirement. So when one spouse passes away in retirement, the surviving spouse often struggles to meet their income needs, or can. It's not always, but it's never exactly the same amount that it was. So life insurance can help offset that. While expenses might be lower, the drop in expenses rarely offsets the drop in income sometimes. So at a minimum, with one of the two Social Security benefits are going to go away. So life insurance is a way to kind of help create that endowment to replace those incomes, should you think that be an issue to replace income. And then if you still have debt after death, then yes, I think continuing to pay for policies is probably a smart idea. Medicare, really quickly. So you must be a U.S. citizen or a permanent legal resident for 5 continuous years and be 65 or older. Under 65, disabled and have been receiving Social Security disability insurance, so SSDI, for at least 2 years before you're eligible. If you're in bad health and receiving dialysis for permanent kidney failure, you're automatically eligible for Medicare then. Or if you have Lou Gehrig's disease or ALS, you're automatically eligible for that too. And I would not wish that on anybody. That is a horrific disease that I know. I have 3 people that I've known that have lost their lives from it, and it is heartbreaking. So what to consider when you're enrolling in Medicare Part A? Most people don't pay premiums for Part A. Once you do, you can't contribute to a health savings account any longer. You're not eligible for marketplace premium tax credits or cost sharing reductions once you have that, once you're enrolled in that Part A and are using it. If you aren't eligible for premium free Part A and you don't buy it when you're first eligible, so in other words, you don't enroll for it, rather you go on and take it, your premium, that's that penalty I was talking about earlier. So when you're 65, regardless if you need it or not, go on and enroll. even if you're not going to use it quite yet. Enrolling and signing up is the key for that. Okay. And it's just, why pay more for it when you can just sign up for it, and even if you don't use it, you're still there. If you're already getting Social Security retirement benefits for at least 4 months before you turn 65, you will automatically be enrolled in Medicare. So that's really nice, important. If not, you'll get your introduction package in the mail along with your Medicare card about 3 months before you turn 65, if that's the case. And the coverage begins on the first day of the month you turn 65, and that's for the automatic enrollment. You may qualify for the disability. We've talked about that. And then you're going to get a special Medicare notice when you turn 65. It'll come in the mail. I would say this: if you have registered a login with the Social Security Administration, you'll get it by email too. If you've done that, I always encourage everybody to go to ssa.gov and create an account, just to kind of look up your benefits and those kind of things. A lot easier than waiting for statements to come, because sometimes they just don't come. So one of the questions that we get quite often is about the about benefits of working with a financial advisor. And of course, I'm in this business and I'm a little biased, but hear me out, and I'll give you some examples of if you're thinking about that, what you can do or what you can look for and what you can expect maybe. And I have people that run their stuff on their own. They do their own plan, but then they've identified, they get to a certain point and they identify ones that either don't want to mess with it, or they're worried about what their spouse is going to do to manage and keep up with it after they go. And so I see it both ways. I see people run it on their own and get to a certain point and hire an advisor. First, an advisor, any good advisor is going to bring an objective approach, and perhaps that's the single biggest cause of mistakes that can reduce performance in your investment portfolio is lack of objectivity. Investment decisions driven by emotion, especially feelings of worry or panic, can undo months or years of hard work. I'm getting a lot of these calls right now, and it's totally understandable. I have one client that is very nervous, and we've proven no matter what the market does, he's going to be okay. But it's still a lot to take in when you look at being down 10, 11%. So we talk through it, and I try to bring up. So I have one client, he's down 11%. He was up 16 last year, so he's still not even down as much as he made last year. And that doesn't make him feel any better, but it also brings perspective. Minimizing taxes, and this isn't necessarily all about lowering income taxes, even though that kind of needs to remain at the forefront of it. But having a yearly look and a plan on taking advantage of gains and losses in an appropriate manner, this helps keep a portfolio efficient, but it also keeps large gains from being eroded by larger capital gains and capital gain events. So in other words, selling and having to pay that. It's very important to have a forward look when it comes to tax planning, to take advantage of the Roth conversion opportunities or tax savings that you can get for the future by acting now. And so, as an example, I think it's very important to have an advisor that works one-on-one with you and your CPA. And they need to have a relationship of dialogue between that wing and your financial advisor wing and yourself. I think it's very important. It's as important as the estate planning attorney added to that. Okay. Creating a financial plan. A good analogy of working with an advisor and having a financial plan would be this. If your retirement years were a boat, and it's your boat. You're the owner. And that entails a long trip, say it's across the ocean. But you're not necessarily the most seasoned captain when it comes to driving the boat across the ocean. Sure, you can go around on the intercoastals and those kind of things, but crossing the ocean is a bigger, scarier, and it's a different skill set, quite frankly. If the advisor is the captain and you're the owner of the boat, then the financial plan is a GPS that kind of tells us which way to go and what to avoid. And it also includes the weather. And it helps you plan for that. So to go the long way around, or whatever it might be. A financial plan will tell you how much you can and can't spend and how much risk you should, and more importantly, shouldn't take. It'll take into account unforeseen circumstances like market drops, increase in spending, big purchases, increases in inflation, changes in growth rates, drops and lowers of what your expectations are. And it also needs to be stressed that any financial plan is not a one-time thing. I know you've heard me say that. It's perpetual. Life doesn't happen in a straight line. Things happen to us in our lives that changes have to be accounted for, and those changes need to be realized and addressed in a real-time manner. Okay. As far as risk management, your investment approach doesn't have to be complicated, but there's an element that ideally is required at a minimum in terms of rebalancing and understanding where we may be in economic cycles and perhaps even market cycles. Any good manager, any good advisor is going to take a long-term approach, and rebalancing at a minimum when the markets are up and even down. And this is a harder thing for independent investors to do. Behavioral psychology has a lot that goes into that. It often leads, to delays in decision making. It's the paralysis by analysis kind of thing. And then the last one is peace of mind. And yes, you might pay an advisor a fee, but peace of mind and having kind of all those ducks in a row is important. So, whether you're interested in working with MCF or a local one, I think an advisor can bring lots of clarity, advantage, and honestly just kind of be that fiduciary partner with you as you're kind of entering these delicate years. I'm going to show you really quickly what we use some financial planning tools here. We enter in information. It creates a net worth statement or financial statement. This can be laid over and integrated in with the estate plan, so we can put stuff in the estate or out of the estate and look at those kind of things, see what tax liability you may or may not have as a result of that. We're going to build, most importantly, a lifetime cash flow for you. So this is John and Susie. They're going to retire in 2025 at age 65 and 63. Looks like they're 61 and 59. They have about 1.3 million in retirement assets at the moment. Their spending needs are a little bit higher because they're saving and doing stuff right now. In retirement, they're going to spend 70,000 a year ish. We're going to account for their Social Security, and their 70,000 a year are going to increase by 2% a year for inflation. So you can start with their income flows. This is their retirement. It makes the assumption you retire right on your birthday. So this is the prorated earnings that they had for that year. You can see the total expenses, how much they saved for retirement that year, the total outflows, and the net difference that's going to have to come from their retirement portfolios. We're not sure exactly under this scenario here, but we would build in Social Security. Looks like he's going to get his full year of Social Security at 67. So he's and then they'll both start getting Social Security here about 2029, and they're full based on this plan right here. So if you would come up to this one in 2027, their income flows would be 32,000 from Social Security. Their expenses are projected to be 87,455, and the net difference would have to come from retirement accounts. As you can see, in the portfolio assets, we put growth rates on. There might be multiple accounts within this. And you can see as you come down, well into their 90s, their expenses continue to grow at inflation, but so do their assets. Now, are they going to go up every year, year over year? The answer is of course not, but neither is inflation. And this is really just kind of that lifetime cash flow that can be built. And then we can add techniques. If you wanted to have a added income, like a side hustle job or a part-time job here, if you wanted to rebalance your portfolios, reduce risk, what happens if you sold your house and rented? How does that affect it? Changing the growth rates. We can grossly reduce this, take it down to whatever we want, change your retirement ages, increase or decrease your living expenses, look at Social Security estimators and get recommendations from that. And if we do it right, if we have everything in there, then we are going to know what your taxable rate is, 4 or 5 years from now. And then, of course, added gifts to charity, unforeseen, got to purchase a new car. How does that affect things? We can add anything we want to on that software and make it go any direction that we want. And stress testing is a big part of that, I would say, too. These are just, I'm not going to talk too much about this. These are some of the offerings, the service offerings that we have. Obviously, we do Social Security planning, education, charity, estate, asset management, and financial planning. Okay, so before we kind of end and I address the questions, there's a couple questions out there now. Throughout this whole deal, I've gotten questions from you all, and a lot of them, it was covered in some way in the material, and some of them were more specific and wanted me to dive in, and so I thought I'd dive in a little bit deeper. And some of them are really good questions, particularly the last two. I really like those questions. So let's just talk about these here, and then if you have more when we're on here, we'll take them, and otherwise you can wait and do it in your one-on-one meeting if that's what you want to do. So how does the spousal benefit work with Social Security? So let me lay the groundwork really quickly, and I tried to simplify it from our previous slides. The Bipartisan Budget Act of 2015 tightened quite a few rules on the spousal benefits, eliminating several strategies that have been used for a long time to maximize how much one person or both people received as a couple. Spouses can still claim benefits regardless of whether they ever held a paid job. If they never really paid into it, then you can file under a spousal benefit based on your partner or spouse's record. To qualify, the spouse with the work record must already be receiving their retirement or disability benefits. So in other words, they will have had to file for Social Security in order for you to get half of that spousal benefit. And you must be at least 62 years and 3 months. As with other Social Security benefits, spousal benefits are permanently reduced if the non-working spouse starts to collect before reaching full retirement age. So if the non-working spouse waits until full retirement age, they will receive the spousal benefit of the full 50% of their partner's benefit. Spouses who are widowed become eligible for 100% of their partner's benefit, their full partner's benefit, unless they also had a job and the benefit they earned through their income is higher. Now, I suppose Social Security would let you file for your spouse's benefit if you wanted to, if it were lower, but I'm not sure any of you all would fall for that. So yeah, we're not going to file for a lower one. We're only going to do it. Generally, the widowed spouse must be at least 60 years of age. There are certain exceptions to that. It gets a little complicated to receive benefits from the deceased spouse's record. And the amount would be reduced if the surviving spouse elects to receive benefits before their full retirement age. So in other words, if you're at or near full retirement age, you get to take the full amount, the very full amount that your spouse had elected and had been taking if you're widowed. Okay. Should I keep paying on my life insurance? And this is why I didn't expand on it on that one slide, because I wanted to do it. So First, it really depends on your policy type. In general, if you retire and you don't have issues paying bills, and you're fully liquid, then you probably don't need life insurance. But if you retire with debt, as we talked about, or have children or spouse that's going to be dependent on you, and there could be a gap after you die, maybe from Social Security, then it might be a good idea to keep that life insurance. Life insurance can also be maintained during retirement to help pay, for estate taxes. But those are very few and far between as well. If you have a term policy, and those are the cheaper, lower cost of the policies that only go to a certain point, and you have that reasonable liquidity to pass on, then most of the time I tell people to not keep the term policy unless you have a need. If you have a permanent policy, then here's what I suggest you do. I would call your agent or your company, and I would request what is known as in-force illustrations for your permanent policy. And you want two types. One, an in-force illustration with you continuing to pay premiums, and another, an in-force illustration with you not paying any additional premiums to see how long the policy will last. I have several clients that have enough cash benefit built up that once we got the in-force illustrations and reviewed them, that it was clear in their lifetime that the cash value was going to earn enough money to, and even if they were taking the premiums from that cash value, that they wouldn't have to make any more. And even if they did, and it got to the point they outlived what we thought they were going to, well, you can always pay a premium and keep it going later. But, the long and short is, let's look for the need first. If you really don't have a need, then the answer is no. But if it's a permanent policy, I wouldn't get rid of the policy. I would just see how long it would keep going if you don't pay on it anymore. Okay. Okay, so what are some of the major pitfalls or mistakes people make in retirement? This is a question, and I've got an answer here, but I've got like 4 main things, okay? And they're really in no certain order. They're just things that I've seen people, seen mistakes that have happened that have cost people, and just a major pitfall. So the first one is not having a risk plan or taking appropriate risk. In some of the other webinars, you might have heard me say to some of the people on here, I'm 46, but sometimes I have to shake my finger at the 60-something-year-olds and shake my finger and say, act your age, and this includes your investments. I've seen people who insist on staying in high growth oriented risk strategy, and a significant drop in the market while they're taking distributions had a detrimental impact to what their plan in their head was. This can also apply to not taking enough risk. I've seen people lately, and the only reason they've called is because the changes in the interest rates have caused the prices in the bonds to drop, and when they log in their accounts are down a decent amount. Now that will change and correct itself over time, because the bonds will still pay what the coupon rate was, no matter what the case is at maturity, unless the bond funds sell them. But taking too little risk is where that inflation and your dollar purchasing risk can come in. Your dollar today will not be worth the same as it is tomorrow. And that's the inflation effect. And those two things on either spectrum are that. I think you need to have a plan with risk. You need to know what you're going to spend, and then we're going to put a multiple of that number. Right now, I'm using, like I told you before, about 10 years, and I want that into safety. And then from there on, we can kind of do that. But all of this is predicated on when you're going to start taking that money out, okay? Number 2, It's not going to be a surprise, but not having a proper estate plan or completing all the steps in one. I've seen people develop a nice estate plan, but they don't follow through on the other end. And so the legwork, you need an advisor or an attorney that's going to make sure you're going to get these things done. And that's the retitling of the assets. My dad was involved in several LLCs, and in the last 2 years, we assigned his ownership interest in all of those LLCs to his trust. There's a process and it has to do it. All the members of the LLCs have to sign off on it. If you don't do that, then it doesn't really help you, in those cases. So there, just because you get the documents doesn't mean you're done with that process. That's where an advisor and a good attorney can help you. Number 3 on that same question, claiming Social Security too early. If you claim at 62, it's likely going to cost you 30% plus in terms of how much you can make, and it's going to cost you that for life. And it might not seem much at the time, but it really can put some stress on you down the road, particularly if we live much longer than what we thought we would. And then number 4, I've said it a couple times in this one, but not planning for the unexpected. And I mean things like big drops in the market, unforeseen purchases, health events, those kind of things. Those are the things I'm most concerned about people being in there. Those are the 4, I would say, major themes that I've seen in throughout that. Everybody has a little bit different and quirks and that kind of stuff. And lastly, and this was a really good question, and it's a little difficult to understand, but we're going to tackle it anyways. There are a lot of people on this call or watching this video that have access to a pension. I'm not going to name the employer, but we got several pensions, or at least 401ks that also have pensions associated with them. Someone asked the question, how does rising interest rates affect the pension in lump sum payments? This was a really good question because it does affect it. When interest rates move up or down, your pension lump sum will move in an inverse relationship. So when rates go up, that's what's happening right now. Your lump sum option that you get, that payment amount, will go down in the short term. Through the pandemic, interest rates dropped dramatically, which had an effect, and it greatly increased a lot of lump sum payments. However, rates have increased significantly recently, and it's causing a reduction in pension lump sum options. And here's why. Properly managed pensions are managed based on the payout obligations combined with life expectancy models for the people who have earned the pension. So in other words, they have to know how much they're going to pay out, and they have to have so much of that in safety in order to ensure that those obligations are met. The life expectancy models, also known as actuary tables and actuary models, are combined with that because they have to project this for the average life expectancy for everyone who is drawing the pension. Okay? So this is a long-term management plan, so significant portions of the pension are likely to be in less volatile or high-rated investment grade bonds. Okay. Typically, bonds have staggered maturity dates. So a bond, I tell people, works a lot like a CD. When a company, and it's in these funds, they go and buy bonds. They buy bonds for X price, and it's going to pay this rate and it's over this time. So you buy a price, you hold it for a maturity period, and then they'll pay you that price on that bond. Okay. These maturity dates help correspond with the liquidity needed to make the pension payments. Okay. So when they make these decisions, when they're running the pension, they're doing this for long-term health and payment for everybody that's doing those. Because bonds and interest rates have an inverse relationship, meaning when interest rates go up, the prices of the bonds drop. Why is that? That's because you now hold a bond that pays less than what is available in the marketplace. So if you were to sell that bond, you're going to get less for it. It's not worth as much as it was because they're offering new bonds at higher rates. Okay. So since they have an inverse relationship, prices, rates go up, the price of the bonds drop. When the old bonds mature, then sometimes that they invest those at new higher rates. So all of this is taken into account in a long run model. But with lump sum payments, they have to keep or generate the liquidity needed for the lump sum at today's prices. So what happens is they're going to have to take a lump sum. They're going to have to take that out of a portfolio now. They're going to sell some assets to do that. They can't have a long-term view of that because that money is needed now. Well, if interest rates are up and the prices of the bonds are down, that affects the lump sum formula. Okay. So, so they're selling, those holdings at today prices. If prices are down, if rates are down or dropping, then that affects lump sum payments too. So in other words, if rates are up, the prices of the bonds are down. If the rates are down, the prices of the bonds are up. It goes both ways. But that's the reason that can affect it. It doesn't tend to affect your annuity type payments because those models are figured over a longer term period than what they have to do in the short term. I thought that was a really good question. And it's going to affect some of you all because there's one plan in particular. A lot of people, the lump sum option is new and they were looking to do that. I don't have all the answers for you that you want on that, but we've asked for them in terms of when do those rate changes and lump sum changes take. They're different with every plan. Sometimes it's at a certain point every year. And, I'll try to get the answers to some of those questions I know some of you all are going to have. And lastly, thank you. 2 years ago when we started this, it was really just to inform and get people to engage themselves in the process, to build that basic foundation on a high level. I've had a lot more engagement in terms of contact with me this go around. It doesn't surprise me. We expanded the age range to 55. We dropped it down from 60. I've had a lot of really nice comments and feedbacks from everybody, and I really appreciate it. Your engagement in this course has really already set you on a path for planning. So you're already off on a great start. The fact that you've taken your time out of your day, out of your week, to kind of read and know this says a lot about you. You know it's important, and you want to make sure that you're making the best decisions that you can. It's never going to be perfect. That's okay. We're not perfect either. It's consistency and really having that plan is pretty important. Schedule your complimentary meeting with me. This is my Calendly link. Reach out to HR of your respective employers. They have it. Reach out to me. I can send it to you. Set up a meeting. We'll probably be getting pushed out, into June very soon on some of those. I encourage you all to give me a call. A lot of this content is been great, and I think it serves a great purpose. The rubber meets the road when we talk about you and your concerns and those kind of things. If you have a specific question on any of this, feel free to kind of reach out on that as well. And, I really appreciate your all's attention. I really appreciate you all attending and doing it. Thank you very much. Let's look at this. My spouse retired at 62 and I retired at age 67, 68. If one of us dies, do we get to collect on both Social Security or only the highest? Only the highest. Only the highest on that case. Good answer. That's a good question, though. That's a tough one. And to give you guys an idea, Social Security, I know more than most, but it's extremely complicated. And most of the time with specific questions, you can get so deep in the weeds. I walk in our CPA's office, who's right down the hall from me, and she's got a book on it that's about that thick. And I just grab it from her and say, I'm stealing your Social Security book again. And I go through it and look up what we need to know in specifics. It is extremely complex. I'm not quite certain how it got to that level, but it is. And it's, I've done it so long, I can't remember everything on that. What other questions does anybody have? Sarah, thank you for saying that. I appreciate that. Any other questions? See if there's another one here. Quiet group today. It's Tuesday. Last call? Okay. Well, on the screen right now, Emily posted into the chat my direct link to my calendar. Set it up. Occasionally, I have to switch those meetings. I had one person scheduled for next Tuesday, and something came up that I have to go do. So occasionally, bear with me on some of that. I think I've got it set up for Tuesdays and Thursdays. That's why it might push out a little bit farther. I'm going to be gone after tomorrow, the remainder of the week. And we'll be back in next week and getting after it. Reach out with any individual questions that you might have. Otherwise, gather the stuff that you've put together. I'm going to ask you a lot of these same questions in these one-on-one meetings. Do you know what your income need is going to be? When are you going to start pulling from these assets? Have you looked at what your Social Security is? How much is that? So, the more you have of that information, the more productive we can be. If your situation is complicated, we can take some time and let me plug it into a couple things and reconvene. But if that's it, I'm going to let you all go. I don't see any more questions out there. I really, really appreciate you all taking part in this. The Pre-Retiree Academy website will be up indefinitely, at least till we get going again next year. It stays up. So you can go back and refer to this stuff on a regular basis. There's a couple of people, lastly, that have reached out looking for referrals from our friend Lyle. I've not forgotten about you. He and I have been playing a little bit of a phone tag. And of course, with my father passing last week, I've had some things to kind of take care of, getting my mom back home and preparing a service in a couple of weeks, those kind of things. So just bear with me. I'm sorry if I haven't gotten back to you on that. Some of it's I'm waiting for Lyle. I'm going to blame it on him. But I really appreciate you guys being here and doing it. So, got one more. John says, in one-on-one sessions, do you perform the Monte Carlo simulations for retirement planning? I can, John. I would need to input it into our financial planning software to do that. And what I would want for that is everything that you would want. I would want to know what your budget is. I would want to know the balance of all your accounts and what those are going to be. We would have to set, even if, a lot of accounts that you all have, I don't have access to, like outside accounts. So I would need to know a reasonable risk for each one of those accounts. But I can definitely look to do that as well. And in fact, I've met with some people one-on-one that my intent is to do that. Just gotten behind with a couple of things, but I'm going to get some help from some of those soon. I've got, I think, 3 or 4 to catch up on. So I'm going to get some help pretty soon on inputting those and getting those things ready and getting back on top of that. So yes, John, we can look at doing that. It's probably a 2-part deal. So I would have to gather the information first and then kind of package it, use our financial planning software, and then we can run all kinds of simulations in it. It's help, and I've got a great person in the office who's getting very close to getting their certified financial planning designation, and is wanting to advance. And so we're going to start working on some of these things together. It's going to be fun. So I appreciate it. Any other last questions? Good question, John. I appreciate you. All right. Well, you all have, I kept you all long enough, 10 minutes longer than expected. Yeah, sorry, a lot to cover. I really appreciate it. You all have a wonderful week, and happy planning. And I look forward to meeting and talking to several of you all in the future. If you're catching this on the replay, reach out. Thanks, guys.